So, what really happens when you give an AI total control over a crypto portfolio and just walk away for a month? I mean, no touching it, no second guessing it, just letting the machine do its thing. Well, we're going to break down an incredible experiment that did exactly that. The big question is the future of trading completely human free, or is it something a little more complicated?
And this quote right here, it gets straight to the point. Look, this wasn't some boring simulation run on historical data. No, this was a live experiment with real money on the line. The person behind this basically put their capital where the AI's algorithm is just to see what would happen.
Okay, here's our game plan. First, we'll quickly go over the whole setup of the experiment. Then, we're going to pop the hood and see how this silicon century was actually built. After that, we'll follow its trading journal week by week for the full 30 days. Then comes the main event, the final scorecard, AI versus a human. And we'll wrap up with the biggest takeaway of all, this idea of hybrid alpha. All right, before we get to the juicy stuff, the wins and the losses, we need to do a quick anatomy lesson. How in the world was this thing actually built to trade crypto all by itself? It really just boils down to three main parts. First, you've got the brains of the operation, the custom AI agent that's making the calls. Second, you have its eyes and ears, all the live data feeds telling it what's going on. And third, you have its hands, the part that can actually go out and make the trades automatically. Now, the AI wasn't just staring at price charts all day. Its entire picture of the world was built from two very different but super important kinds of information: the hard, cold data from the blockchain itself and the much fuzzier human mood of the market. Okay, so first up, on-chain signals. Think of this as the raw, unfiltered truth. It's not someone's opinion, it's the public record of every single transaction. The AI could use this to see if, say, the big players, the whales, were buying up an asset or maybe getting ready to sell. It's pure data. The second piece of the puzzle was sentiment. The AI was plugged into a pipeline that was constantly scanning crypto news sites and social media. It was basically reading everything and scoring the overall vibe. Was the chatter positive, negative, or just kind of meh? This was the AI's ear to the ground. So how did it actually place a trade? Through something called a DeFi protocol. Just think of DeFi as all the things a bank or broker does, but built as code on a blockchain instead of in a big office building. This let the AI connect directly and trade automatically, 24/7, without needing a person to click buy or sell. Now, they didn't just let this AI run wild. It had some very simple, hard-coded guardrails. First, it could never put more than 20% of the money into one single asset. Second, it would only make a move if its own confidence in a trade shifted pretty dramatically. And most important, if the whole portfolio ever dropped by 12%, it would automatically stop to prevent a disaster. So day one, the AI makes its first move. It put 40% in Bitcoin, 25% in Ethereum, and then a pretty big 20% chunk into these smaller DPIN tokens. It also kept 15% in cash, basically in the form of stablecoins. And what's fascinating is the creator said, "I would never have built this portfolio." And that's the whole point, right? To see what the machine would do differently. Okay, the scene is set. We know how the AI thinks and acts. So now, let's roll the tape and see what happened when this thing went live for 30 days. This is where it gets good. The whole month was a real roller coaster. The first week, the AI looked like a genius. The second week, it made a rookie mistake. The third week exposed a huge blind spot. And the fourth week was all about trying to recover. Let's dig into each one. Week one was a huge win. That sentiment scanner picked up on some negative buzz around crypto regulation. It sensed the mood shift and moved a bunch of money into the safety of stablecoins, a full 4 hours before the rest of the market caught on and prices dropped. This is exactly what AI is supposed to be good at, processing info at lightning speed. But then, week two happened. The AI saw a massive spike in trading activity for a small token and jumped in, thinking it was about to take off. But it never did. The AI got played. So how could a super smart AI get tricked like that? Well, it fell for a classic trick called wash trading. This is where someone basically fakes a bunch of trading activity by buying and selling an asset to themselves over and over. The AI saw the data, it saw the high volume, but it had absolutely zero context to understand that the activity wasn't real. It saw the signal, but it totally missed the lie. And that lack of real-world context popped up again in week 3. There was a huge economic event coming up. The U.S. Federal Reserve was going to announce an interest rate decision. This kind of news moves every market, not just crypto. But the AI's whole universe was just blockchain data and crypto news. It had no concept of the wider economy. It just sat there and took a hit that a human probably would have seen coming. So after a month of some brilliant moves, some really bad fumbles, and some serious blind spots, how did it all add up? Let's get to the final scorecard. It's time for the human versus machine showdown. And here are the numbers. Over the 30-day window, the AI's portfolio finished up 8.6%. The human-run portfolio over the exact same period was up 6.2%. So yeah, believe it or not, even with its mistakes, the AI actually came out ahead. But that's not the whole story. Take a look at this. The AI made 23 trades in a single month. The human, only about 6. The machine was constantly fidgeting, rebalancing, reacting to every little blip of data it saw, whether that data was real or totally fake. And this really makes you wonder, right? Sure, the AI won on points, but was its frantic, hyperactive strategy actually a good strategy? Or did it just get lucky while taking a ton of unnecessary risks? It forces you to think past just the final number and look at the quality of the decisions. And that brings us to the real takeaway from all of this. What's the ultimate lesson here? What did this 30-day roller coaster really teach us about AI's role in making complex decisions? Let's just put it on a simple scorecard. The AI's strengths are obvious. It's incredibly fast, it has zero emotions like fear or greed, and it acts instantly. But its weaknesses are just as massive. It is completely blind to context, it can be easily fooled, and it has no clue about the bigger economic picture. So here's the bottom line. The big insight isn't that AI is a better trader, full stop. The real advantage, the alpha, isn't pure AI or pure human. The experiment suggests the best approach is a hybrid model. It's a partnership. You let the AI do the heavy lifting of processing data 24/7, and you have a human provide the wisdom, the context, and the big picture view the machine just doesn't have. And this really feels like the path forward, not just for trading, but for so many other things. It leaves us with this one last, pretty mind-blowing question to think about. If you have an AI that can handle all the infinite data, and a human who provides the wisdom, what are the limits